Hello everyone, hope you're all doing well. I'm back making videos. For this video, I will be discussing a question I received from a viewer. The viewer's name is Roy, and Roy had a question regarding capital gains tax and the sale of his holiday home. So let's have a look at it and see what are the tax consequences. Right, so Roy sent me an email and he said, "Hi Anrich, I trust you are doing well. Can you please assist with this question? What is the CGT capital gains tax for a person selling his second home in brackets his holiday house for 1.2 million South African rands? The base price for which he bought the house in 2010 was 500,000 rand. Then he's asking her marginal rate is 20%. Kind regards, Roy." Alright, if we look at the question from Roy, we see that he has a holiday house. So what this means is it's his second home and he goes there for holidays, and he has a selling price of 1.2 million rand. Then in 2010 he originally purchased this house for 500,000 rand. So we can see that the house has accumulated in value from 2010 when it was worth 500,000 rand up until the current time where it is now worth 1.2 million rand. Okay, let's look at the answer that I've prepared. So you will see at the top, the client is Roy. We're working on capital gains tax and we're currently in the 2024 year of assessment. So we will need to apply the rates for tax that applies to this 2024 year of assessment. To be able to do the calculations, I as a tax professional will need to make a few assumptions as limited information was shared to me by Roy. So the first one is that the house was not rented out but only used for private purposes during holidays. So during the year, Roy did not rent out the house. He did not receive rental income. In other words, other income that he would have had to also consider for tax, but he only used this holiday house when he went there during the holidays. The second important assumption is that Roy is less than 65 years of age. If he was older than 65, there may have been additional rebates that would have been applicable. So we're saying Roy is less than 65 years of age. The third assumption is that Roy is not a provisional taxpayer and did not receive any other income. Okay. The fourth one is that Roy is not married in community of property. If he was married in community of property, he would have had to share the capital gain with his spouse being married in community of property. So for this question, we're assuming that he is not married in community of property. Okay, let's get on to it. So we're saying that Roy sold the house, the holiday home, for 1.2 million rand. The selling price for tax is called the proceeds, and this we can find in paragraph 35 of the 8th schedule to the Income Tax Act. Then Roy said that he originally purchased the property for 500,000 rand in the 2010 year. If we look at base costs, there are a number of costs that we can include in base costs and that we can deduct from the selling price. The first of which is the purchase cost that Roy provided to us. Roy could also have considered the transfer cost when he originally purchased the property, as well as commission paid to attorneys on the purchase or the sale of the property, and also improvements. So Roy purchased the property in 2010. If he had made improvements to the property, in other words, he has expanded the property, he has built something additional to the house, that cost can also be added to the base cost. Then we see basically that Roy has a capital gain of 700,000 rand, and we get that by deducting the 500,000 rand cost from the 1.2 million proceeds. For individuals who are still alive, in terms of paragraph 5 of the 8th schedule to the Income Tax Act, an individual can deduct 40,000 rand per tax year from their capital gain. So you can see that the 700,000 original capital gain we then reduce with 40,000 Rand, and then we get a subtotal of 660,000 Rand. Now for individuals, they can include capital gains in their taxable income at 40%. So here we can see that Roy purchased the prop or has a subtotal of 660,000 Rand, and then we only have to include 40% of this subtotal in the calculation of Roy's taxable income. Alright, so one of our assumptions above, we said that Roy didn't receive any other income. So if we work on that basis and we work on a taxable income of 264,000 Rand, Roy will be taxed in the 26% rate of tax. So what we then see is that we calculate Roy's tax as follows. So the first one will be, there is a basic amount of 42,678. We then plus 26% of the amount above 237,100 Rand. Okay, if we calculate that in the formula shown, it will provide Ray with a normal tax of 49,000 Rand 672. But we don't stop there. The next thing we do is we consider the primary rebate. So for the primary rebate, each individual receives a primary rebate, and this can be worked back to the tax threshold. So if you think of the before tax amount of 95,750, the tax amount on that will be 17,235, and that we are able to deduct from the tax payable that Roy has of 49,672. So we say 49,672 less the primary rebate will then give Roy tax payable of 32,000 Rand 437 on the sale of his holiday house. Okay. If Roy was older than 65 years, you can see that he would have qualified for a secondary rebate, and if he was even older at more than 75 years, he would have qualified for an additional rebate, as can be seen in the table on the screen at the moment. Okay, so Roy, I hope that answers your question. Thank you for sending it, and you're welcome to provide me with any comments or answers or feedback on this video. I do appreciate it. I also want to thank you for sending in the email. Viewers are welcome to send me mail with questions they have, and I will select some of those mails to do video answers. I think that I want to share the answers with the viewing community so that we all can try and learn more about tax and make the world of tax a little bit more simpler and understandable. Thank you for watching. I'll see you again in the next one. Bye.